Welcome to Passive with Property, the podcast that explores the world of property investing with expert insight and practical advice. I'm your host, Dragan Dimovski, and today we are thrilled to have Mike Mortlock with us. Mike is a managing director at MCG Quantity Surveyors, one of Australia's fastest growing quantity surveying firms, and a qualified real estate agent. Mike has helped out thousands of property investors maximize their tax depreciation deduction and cash flow, from their residential to commercial sites worth over $100 million in construction value. Mike is also a regular property commentator on various media outlets. This includes Australian Financial Review, Australian Property Investor, realestate.com.au, news.com.au, and more. We can't wait to hear his insights on property investing, so stay tuned.
Welcome to the Passive with Property podcast, hosted by Dragan Dimovski. With over 2 decades of property investing, Dragan is a qualified property investment advisor and buyer's agent. We're committed to the education of both first-time and seasoned investors in property investment and wealth creation. The Passive with Property podcast is brought to you by the Buyers Agency Australia.
Okay, Mike, thank you for coming on. Welcome to the show.
It's a pleasure. Thanks for having me, Dragan.
Not a problem. It's our pleasure. So, Mike, can you tell our listeners a little bit about your background and how you became interested in property investing, please?
Yeah, look, I guess property investing was something that probably came on the back end of the work that I did as a quantity surveyor. So I did have a very short career as a real estate agent, but even, that was only about 10 months. But even then, I guess I didn't really understand property investing that well. I didn't have a great financial mentor. I mean, I think my mother gave me the Rich Dad, Poor Dad book, and I probably didn't read it, which is shameful because a lot of people cite that as a real influence for them. But when I started working in the world of tax depreciation, you see these people building portfolios and, retiring early, whereas I came from the country, the quintessential sort of ochre sort of work ethic. I thought that everyone just kind of slogged it out hard on the land and then, didn't necessarily retire until they couldn't get in the ute anymore. But yeah, that got me really interested in property and, studying valuation and construction management and seeing the success of other people and educating myself. I became really excited by it. And when I started buying property, I was, I've always been wanting to acquire more. I'm still in that sort of phase now.
Okay, awesome. Can you dig a little deeper with your investment experience in property, please, before we actually get into what you do day to day?
Yeah, well, I'm probably a more successful business owner than property investor. I've got a modest portfolio, but of course, working with tens of thousands of investors over the years, you see where they're buying, what works, what doesn't. We're in a great position to be able to analyse, where people are buying across the country, the types of things that they're buying. And we share a lot of that data online as well, obviously not specific, but we look at, 1,000, say, transactions and where are they, how much people are spending, are they houses or units, are they brand new or established? So we publish that in a white paper each year. But my first property was a property that I purchased using sort of the valuation idea where I was thinking about comparables. So it was a 2-bedroom place that had 2 living spaces, and I very cheaply converted one of those into a main bedroom and created just basically a little box to extend the front foyer so I could put a door on the side of the house and turn that into sort of a separate bedroom. So I rented that bedroom out to somebody. So that was kind of my first foray into property investing. And since then I've, I suppose, to describe my sort of philosophy around that is that I like to sort of go, I'd rather have multiple assets at a lower price point than necessarily going, $1 or $2 million blue chip style properties, and something that ideally is paying for itself because, once you're buying a few properties, it becomes a serviceability game, right? So you've got to try and find ways that appeal to the bank to enable you to keep going.
Keep going. That's right. And usually that price figure is around that 400 to around 600, would you say, these days?
Yeah. I
Yep.
think so. Yeah, and there's still, that doesn't get you much in capital cities these days.
Yeah.
You used to be able to go to Hobart and have a great time with that, and even places in Brisbane, but they've had a real good run. But there's a lot of evidence to say that regions outperform capital cities, and it's great if you can buy in the capital city and you can service a negatively geared asset, because the yields are always very low, and plenty of people have done really, really well there. But it's not necessarily my philosophy.
Yeah, no, that's fine. And going back to that house that you purchased, and just for the listeners who are starting out, you pretty much, what you did was picked out a 2-bedroom house that's got 2 living areas, and you put a wall across one of the living rooms and made it into a 3rd bedroom. And now suddenly you've also got additional equity on that property as well.
Yeah, at the time, it probably increased the equity by somewhere around $60,000 or $80,000, because the comparable sales for 3-bedroom properties as distinct from 2-bedroom properties, and having I almost was a valuer, so I studied valuation before moving over to construction management. So I kind of understood the different valuation methods, and the comparable, when it's available, is the most preferred one by valuers. And I can just kind of see that if I could manage to find the money to be able to do that, then I would be getting, a 3 or 4 times ROI on those works. So I think it probably cost me about $14,000, but that also included a built-in wardrobe and a few other bells and whistles. So I probably could have done it, around about 10,000, and for about 60 or 80 grand in equity uplift.
That's perfect.
Yeah, that was where I was kind of like, all right, I think I can do this game.
Yeah. So for beginners out there that are listening, can you throw some tips out there on what to look for? What sort of steps do they need to take to find these types of properties?
Yeah, look, the finding is one part of the game, but I think the most important part is the planning the game, because I like to describe it as, you can have your lollies, but you got to eat your veggies first. And I think the lollies is the property, right? And everyone gets excited by hotspotting reports, and this is the area that's booming, and this place is going to go through the roof. But unless you understand what it is you're trying to achieve, you can get really kind of sucked into that stuff and not necessarily be purchasing properties that get you to that end outcome that you want. Now, that might be, you want to retire on a certain income, or you want to have a certain number of properties. But I encourage everyone to think about that, because I think that's the most important. And then it depends if it's your first property or if it's your 15th property. They're going to need to be different, because they have different roles, right? Like when you get later on in your journey, you're probably wanting things that are going to be higher in cash flow, right? Whereas in the beginning, to accelerate your growth, you really want something that's going to grow in value, because then you can redraw that equity
and move on to the next.
Yeah. So, I mean, in finding those properties, my best advice is to use a buyer's agent. They're doing it day in, day out. They're experts in that. They have the relationships to be able to source the off markets. And, off markets can be a little bit of a beat up. It's a bit of a sort of, it's a buzzword sometimes. And anyone can get an off market if you have that relationship with the agent. But
that's right.
The buyer's agents, they're doing multiple transactions with particular agents, and you do get a better level of access. So, and if you can't do that, then it's just educating yourself and doing the research, and you'll probably find podcasts like this, and there's plenty of other podcasts. Sorry, I don't mean to plug
No, go for it. Yeah.
There's plenty of ways that you can educate yourself out there. So I think you've got to have a plan, and you've got to take it pretty seriously if you are going to do it yourself.
Yeah, definitely. Read as much, listen as much, watch as much. Yeah. Educate. That's what I always say on this podcast. Yeah. Awesome. So tell me, Mike, how do you help property investors maximize their tax depreciation and and their cash flow?
Yeah. Yeah. So, I mean, that's the real job of a quantity surveyor when it comes to the tax side of things is just improve their cash flow. So, there's plenty of examples of depreciation schedules we've done for clients where there would be a negatively geared property pre-tax, but after tax, it's either going to be neutral or putting money back in their pocket.
Yeah.
So, in essence, let's say you're on $100,000 of income, just as a round figure. And we do a depreciation schedule that says, let's say it's got $11,000 worth of deductions in that financial year. Then in the eyes of the tax office, instead of you earning $100,000 a year, on paper you're earning $89,000 a year. So you're taxed on that lesser amount. And if you're on $100,000 a year, you're going to be paying around about $24,000 in tax. But on $89,000 a year, you're going to be paying about $20,000 in tax. So it's just a bit below, say, $4,000 in tax saving with a schedule like that, and then it depends on your marginal rate for what comes back into your pocket. But it could be $2,000 or $3,000 that you get back in your pocket from that schedule. So that's the real benefit. Any income producing asset that you buy, whether it be a rental property or a resi rental property or a commercial or something like that, you're able to claim for the decline in value or the wear and tear of the building over the years. And that's where a construction cost estimating specialist like us is able to figure that out and to give you a report showing you what you can claim each year.
That's right. Yeah, that's right. Because I know I deal with clients, and sometimes we look at a pretty decent property. It's purchasing under market value, but it's $2,000. It's $2,000 negatively geared, but the property is only 8 years old, and it's trying to explain. Well, hang on, no, it will be positive geared after the depreciation. So and it's sort of understanding how all that works. And again, it's just coming down to educating yourself and knowing. Talking to someone, a professional like yourself, if that's possible with that particular property before they purchase it.
Yeah, and a negatively geared property is not necessarily a bad thing, and it's also not necessarily a good thing, right? It's just a tax position, it's a tax outcome. Now, if that property is costing you a few grand a year to hold on to, but it's growing at 7%, well, that's the clear benefit. But you've got to be able to service that. You've got to be able to chip into your pocket to hold on to that, because you don't want to be forced to sell that because you didn't understand or prepare for those costs. And that's where, depreciation can absolutely help you out, because it just makes it a little bit easier to hold on to.
Exactly. Okay. Can you share some of your successful strategies for property investing?
Yeah, well, I mean, as I say, I'm normally on the other side of this microphone talking to people about their strategies, and I'm a humble tax depreciation guy. But I think getting back to that original point of the planning, I can't. I know I've mentioned that before, but I can't sort of share that with too little enthusiasm, because I think that's the most important thing. And as I mentioned before as well, property investing, if you're wanting to get to a multi-portfolio position, it becomes that game of finance. So you need to consider, well, what am I doing personally that's going to affect my financial situation? Do I have credit cards or car loans or terrible things like Afterpay? You've really got to clean up your act if you want the banks to be happy with you. And also the selection of the properties can put you in a position where you can't go further. So if there are ways that you can, increase your own personal income or purchase properties that are going to position yourself better for the banks, then that's how you can grow that. And I think that's the most important thing for property investors to understand, and also getting that first asset right, because the numbers are still telling us that 72% of property investors are only buying one property.
That's right. Yeah.
If that's your goal, then well done. All power to you. That's a fantastic result. And most people won't own an investment property. I think it's only 20% of people that will. But people that get into property investing probably do it, I think, to fundamentally change their financial future. And there's a pretty strong argument to say that one property is not going to be enough to do that. So you need to kind of think about, well, how do I strategize to leap into the next one? And as I mentioned before, again, the the best tip that I can get when you're selecting the first asset is to avoid companies that are sort of doing things like selling what I do, right? Because often when depreciation is used as a selling point, it's because there's very little positive attributes about the investment itself, especially if we're talking off the plan apartments and things like that, where there can be an oversupply of that. So depreciation's a bonus, not a strategy. But yeah, you want to be getting that first one right. That's where I think a buyer's agent can help.
Yep.
I definitely prefer houses over units over the long term. They perform better, and there's that bigger land component as well. Yeah, that first one is key. Something that's going to grow, but it's also got the cash flow to be able to support itself, so you're not having to chip into your pocket.
Exactly. Yep. Like you said before, that's right. So, in your opinion, Mike, what are the sort of current trends and opportunities in the current market today in Australia?
Well, I think if you're looking at interest rate futures, and the last time I looked at it was a couple of weeks ago, admittedly, and it was sort of looking around about August, where it was priced that we start seeing some reductions in the cash rate, or at least, the end of the rises. So I'm expecting that before the end of this calendar year, 2023, we're going to start seeing some green shoots. So I think it's important for anyone that can get into the property that they do it before that time, because yes, interest rates they do correlate to property prices, and there's a lot of lagging indicators that the RBA is making their decisions on the cash rate on that. They themselves are saying we haven't actually seen the impact of that, right? I think there's probably another 50 basis points to come. So there's probably still a little bit of a window. But the property market fundamentals are so strong that once we start rebounding, I think there is going to be a rapid pace of growth. You've just got to think about things like the vacancy rates. We're talking, I think it's 16-year record lows.
It's crazy.
Yeah. The crisis levels of accommodation. The unemployment rate is extremely low. It's unsustainably low for an economy that needs to have capacity. And there's a lot of restaurants and places like that can't get the staff, right? So there's job opportunities. There's also parts of the country that've got some big infrastructure spends coming. Like Brisbane with the Olympics and those sorts of things. So I think the trend will be the pace of decline of property will slow. And once we start seeing those green shoots, I think we're off for a bit of a run. And I encourage people to not necessarily wait until that they know that the property market is on the increase, because often you can miss out on a big chunk of that percentage growth by being late to the party, because once it says we're off to the races, it's often a little bit too late to get the majority of that growth.
Are you stressed out not knowing where to find distressed, off-market, high cash flow properties in high growth areas? What about the best strategy to build a wealth-generating portfolio? Look no further. Dragan Domovsky can help. With 20 years of experience as a property investor, Dragan is a qualified property investment advisor and expert buyer's agent, so he knows how to find the best deals and negotiate for his clients. And right now, he's offering a free 45-minute strategy session to get you started, normally worth $500. Text the code PWP along with your name and email address to 0405 105 074 now to take advantage of this offer. Don't wait. Take control of your financial future today. That number again, 0405 105 074. You're listening to the Passive with Property podcast, hosted by Dragan Domovsky. To ensure you don't miss out on valuable investing tips and information, subscribe today.
So, Mike, with the vacancy rate being so low, are you seeing a big demand for rooming houses? How popular are they becoming?
Yeah, it's a good question. It's not a metric that I tend to follow too much myself, but certainly boarding houses, we've seen a lot of those constructed in places like Victoria. We've seen some businesses that have gone into that space because there's just huge demand for it, right? These are places where people that could quite possibly be ending in crisis accommodation or homeless, heaven forbid, are able to access these community style living things. So I think the community model is going to be long term more popular than the boarding house, because that only sort of attracts a certain type of demographic. But there's certainly opportunity for people to get into boarding houses, and they have a very, very strong yield. Whether they have a capital growth to match that yield is the most important question. So, and especially important for people that are just beginning their journey. It's probably something that you would be looking at later on when you're wanting to get that return and perhaps live off that income. But yeah, I think the low cost rental accommodation is going to be popular, just because we are in such a dire situation, and the borders are opening back up to international students, and we'll continue to see some more tourism as well. So yeah, it is an opportunity for investors.
Yeah, awesome. Okay, how do you approach risk management in property investing, and sort of what strategies would you take to minimize the risk?
That's a good question. Something that I wish you'd put in writing to me beforehand, because you're putting me on the spot here, Greg. No, I like the free-flowing sort of organic conversation, so I can't have my cake and eat it too, right? I think risk from a property investment point of view is a very personal thing. And if you are investing with somebody else, now that might be as a joint venture or with your significant other, that's a really important conversation to have before you start the journey, not when you get to the point where you're like, oh, this cash flow is killing us, and you realize your partner didn't want to do it in the first place. You're much better to compromise and find a position that you're happy with. But there are plenty of ways to mitigate risk. I think probably the most important is always having a cash buffer. So, things can go wrong with property. You can have unforeseen expenses and repairs and maintenance. And yes, you can claim them as deductions, but you've got to have that cash available. So I've heard people say, say a buffer of $10,000 per property in your portfolio, always sitting somewhere like in an offset account that you can access. That's really important, because if you're forced to sell a property, it's an expensive game getting in and out of property, right? Because you've got to pay the real estate agent when you sell it. You've got to pay the stamp duty at the front end. So making sure that you're prepared for those unforeseen expenses is one of the biggest things outside of the planning about your risk tolerance and your risk profile. I think diversification is always important as well. There's a lot of sort of anecdotal evidence that your average property investor buys around the corner from where they live. Now, it might be nice to be able to drive past that particular place and make sure that it's still going okay, but the chances of you living in an area that's also the best got the best capacity for growth as a property market is unlikely. And when you question people about, okay, well, why do you want to buy in that suburb or the next suburb from where you live? And they say, oh, well, we know the area. And you dig a bit deeper, and what they know is where the good schools are and where the good coffee shops are, but they don't necessarily know what the pipeline is, for construction activity or development starts or infrastructure. These are probably much more important things to understand than where the good coffee is. Local knowledge is good, but you've got to think about moving further afield. It's actually a figure that we tracked in our data, and I've got it pinned on the wall right next to me here, which is very convenient.
Okay.
In 2019, the average distance from where people the distance from where they live to where they invest was 293 kilometres. Between 20 and 2021, it jumped to 559. So, across both those data sets, it was about 6.9% of people buy in the same suburb of where they live. So that's not as high as a lot of people would think. They would think.
I would have thought it was much higher, yeah.
Yeah, I did as well. I was quite surprised by that. There's, let me give you another one. Less than 50 kilometres from where they live is 60%. Now that dropped down to 41%. So I think there's still a desire for people to buy things that they can go and physically inspect themselves. But if you're using the services of a buyer's agent, then you can outsource that and you can look at the whole property market market. So
Yep.
I think it's important to make sure you're not placing all your eggs in one basket. And the property markets all move at different times. You know, like we're sort of seeing WA on an upswing, whereas, you know, Queensland has had its boom and Hobart had its boom quite some time ago. And some of these markets might not perform for 6 or 7 years. They might be flat and then they want to go. You don't necessarily want to be sitting on your hands for that period of time. So those are my 3 tips: the cash buffer, diversifying across the country, and understanding that risk portfolio and making that part of your plan.
There you go. You didn't need that question before answering. You did it well. Good. We got there, Mike. Thank you. Okay, so can you tell us about particular challenging projects you worked on and the outcome of them?
Yeah, that's a good question. I mean, in the work that we do, there's all sorts of challenges that pop up from time to time, and you know, the guys sometimes will be working on a job and they're like, oh, this is gonna be the one that finally does me in. But in our game, I always sort of say there's no such thing as a bad job. There's just bad information, and that's, I think, an important thing for investors to understand as well. As much as it makes our life easier, but when you are investing in property, you want to keep a good record of all of the improvements and the costs and the additions that you've made to the property. That's always something that I think comes back to bite people. And one good tip, especially if you've got a property manager, is all the expenses that are incurred, you can actually give those to your property manager and they'll give you the rental statement, which will show you the cash inflows and the outflows. And hopefully they're classifying to say, well, this was a plumbing repair and this was a new hot water system. And you can give that to your accountant. But did you mean sort of professionally or with
exactly. You got that right.
So information is probably the key one. But, you know, we also see some nasty things that happen on the construction side of things. I mean, we've been involved with expert witness reports on an $80,000 retaining wall that went to $200,000 in legal fees as a dispute. You know, there's crazy things that happen when you get 2 egos wanting to fight and they're fighting for who's paying for costs, and it just kind of gets out of hand. So when it comes to construction, like if you're looking at doing a development or building a house yourself, a lot of people avoid the upfront costs of the consultants. You know, like if we're doing a full detailed estimate on say a development, then, you know, it could be $2,000 or $3,000, but the banks always require a quantity surveyor to be involved. And why are they doing that? Well, it's because they're saying that they might have the financial understanding, but they don't have the skill set to be able to manage that project from start to finish and make sure that the cash is being allocated at the appropriate times to make sure that they can always sort of maintain a cost to complete if something happened to that development. So I would say it's really, really important to understand the value that consultants can provide and not necessarily avoid those upfront costs. And buyer's agents are a great example, right? Yes, you can claim that off your cost base when you sell, so you can get some of that money back. But a lot of the trouble that beginning investors have is that, you know, they've got to save for that deposit. And if there's a buyer's agent fee on top, it's like, oh, well, that's going to take me a little bit longer, or it's going to change the type of property that I can buy. But, you know, I've seen buyer's agents pay for themselves just in the negotiation part. I've seen them pay for themselves just in the due diligence part. And then you kind of think the difference between a property that grows at 6% a year or 7% a year, that really makes the buyer's agent fee very, very insignificant over the long term.
Okay, and one last question, Mike. What advice would you give to someone who is just starting out in property investing?
Yeah. Well, congratulations for listening to this to begin with. And I think that you're on the right track already. But I think educating yourself is important. There's plenty of resources out there. You know, pre-podcast, there was, you know, YouTube things that you can look at. There's lots of great books out there. There's lots of really good and helpful Facebook groups and forums that you can join where you can learn from experts, you can learn from other people. But you also kind of want to go in there with a bit of skepticism to figure out, well, what is this person's agenda? Because there are agendas in property, there are spruikers in property. So you want to be able to find people that you like and you know and you trust. And then I think it's just all about making sure you get that first one right. You keep a cash buffer so you don't get yourself into a difficult situation, and you understand what it's going to be like going in. Is it going to take money out of your pocket? Is it likely to grow and you're going to be able to pull the equity? What is your strategy? And carefully going out and putting
fantastic.
that into
and
action.
Mike, coming back to the education part, you can give your podcast a plug.
My podcast. Yes. So I've been doing a podcast called Geared for Growth. I think for 5.5 years now. You got one of those little memory reminders. Yeah, it's been a long time. So I think we've got something like 240 episodes. One with your good self as well. So check that out. Episode, can't remember what that is, but search for Dragon. And I've interviewed, economists, mortgage brokers, financial planners, buyers agents, all sorts of people in and around the property space.
Yeah, definitely go to Geared for Growth and have a listen. I'll also put a link below in the description. And if people want to, besides the podcast, contact you, Mike, where can they go?
Yeah, the easiest way is through our website, which is just mcgqs.com.au, or you can go to Facebook or LinkedIn. I hang out in those places, and you'll see some videos and interviews and things that I do that, and always happy to help people out where I can and have a chat.
Mike, thank you for coming on.
Thank you.
And you have a wonderful day.
Thanks for listening to the Passive with Property podcast, hosted by Dragan Domovsky. For valuable information on property investment and wealth creation for both first-time and seasoned investors, be sure to subscribe today. The Passive with Property podcast is brought to you by the Buyers Agency Australia. Are you stressed out not knowing where to find distressed, off-market, high cash flow properties in high-growth areas? What about the best strategy to build a wealth-generating portfolio? Look no further. Dragan Domovsky can help. With 20 years of experience as a property investor, Dragan is a qualified property investment advisor and expert buyer's agent, so he knows how to find the best deals and negotiate for his clients. And right now, he's offering a free 45-minute strategy session to get you started, normally worth $500. Text the code PWP along with your name and email address to 0405 105 074 now to take advantage of this offer. Don't wait. Take control of your financial future today. That number again, 0405 105 074.